discussing the basics of trading from order flow. So how can we now start to capitalize on it? Okay, in this video, we are going to be discussing on quite a few things right here. Now they all tie in together, so it's just one story right here. So without further ado, let's also dive straight into it. Okay, first of all, the definition. We need to understand that if you want to trade from order flow, then the biggest mistake is not trading from order flow in the first place. So what I mean by that is this is something I've touched on in the previous videos as well, where you always want to trade from the most recent order flow legs. If you're not trading from the most recent order flow legs, you are actually not trading from order flow. I will not go over another example because I've touched on this before as well. If you do not understand it, then again, I would advise go back a few videos because you might have missed it. Okay, then the conditions. So the first thing we want to understand when trading from order flow is that we need a clear higher time frame objective. So again, think of the market structure that we talked about in alignment with the overall higher time frame trend. And also it being a clear trend. So no consolidation, no fair value gaps failing, etc. Just a clear trend. Then the two types of order flow that we are talking about is we have normal order flow, which we also refer to as usual context right there. And we have fake order flow, which we've gone over as well, which is essentially unusual context right there. So these are the two types that you will be trading. Now, you will always be trading usual context, because even if it's unusual context, you will still inside of unusual context be trading usual context. So normal order flow is always going to be the main focus. What does that mean? And what is usual context? Usual context in the form of a fair value gap looks something like this. So here we have a push higher. We leave behind this fair value gap right there. That means that from that fair value gap, that is the discount rate we want to continue higher from. So that is what we can continue higher from on, for example, the higher time frame. Now, the first premium rate that we will encounter, the first liquidity area that we will encounter in this case is this swing high right there. Now, if this swing high was not there and there was only a previous candle high, it would have been the previous candle high right there. But in this case, we also have the swing high. So the swing high is the target. That's the context target right there. So we have the context boundary in the form of the fair value gap and the context target in the form of the swing high right there. This is our context area right there. The green area is our context area from the fair value gap towards the first context target, the first swing high in this case. So it's important to understand because this is us moving from a higher time frame level towards a higher time frame level. Higher time frame level in the form of fair value gap towards then liquidity right there in the form of that swing high. Now that's important, something we're going to touch on in just a bit as well. So what we're expecting on this time frame of our context time frame is the following: a sting into that fair value gap to then at least reach the context high right there, the context target. Now, whatever happens there is something we're going to discuss as well. But another type of context that we have, which is also usual context, but instead of it just being a fair value gap alone, we also have the fair value area right there. So when there's a scenario like this, I always prefer, and especially a scenario where the fair value gap is very close. So if we do retrace, it's very close already towards the fair value area, and both of those things are overlapping. Then I like to use the fair value area right here because then you have two discount arrays. You have the fair value area and the fair value gap. Now, take the overlapping part right there, which is the fair value area high right there. And that is, again, that context area towards the swing high, the first premium rate that we encounter. Again, this is not new things, but now we're bringing into light, with order flow as well. So this right here is the context area that we focus on. So what we're expecting, or what we ideally would like to see, is a sting into that fair value area to then reach for the swing high sitting right there. Now, if we then move on, what is usual context on different time frames? Now it gets interesting because now we have to understand and navigate those different time frames. So when we look at this scenario, and let's assume that it might be the daily time frame right there, then on the daily, this is institutional higher time frame levels. So what is happening on the daily? We move back into that daily fair value gap. institutional higher time frame level where we can continue higher from again, towards that swing high right there, which is also an institutional higher time frame level. So this is what happens on the daily time frame. Now, what does that look like on, for example, the 15-minute time frame? Because on the 15-minute time frame, this then turns into a market maker model. So here we have that same fair value gap that we have on the daily time frame. We have that same swing high, our context target right there on that we saw on the daily time frame right there. So we keep those on our chart. We always want to be aware of those before we dive into the lower time frame. Then here, this is what we ideally want to see on the lower time frame, on the 15-minute time frame in this case. This is what happens inside this bigger daily candle right there. So a market maker model. And the market maker model does not form anywhere. No, it forms in very specific areas. So this is essentially how I got to the understanding, hey, where do order blocks, where do fair value gaps on the lower time frame hold? They hold in context areas right there. And those context areas are what a lot of people also refer to as market maker models right there on the lower time frame. This is what you want to be focusing on. Now, the name market maker model is not super relevant to us because what happens here on the right side, we just simply want to use order flow entries to then target that swing high right there. We need to understand that those form at context areas. Okay, then what do we do when context is taken? Now, let's again take this example right here. And we've reached the swing high right there. What happens? Well, this swing low right there could potentially be a target, but that's under a certain condition. Because that's under a condition where the daily is offloading positions at the swing high right there. So the reason why after we reach a context high or a context target, can also be a context low, of course, in a bearish scenario. But when we have reached a context target, the reason why you want to take a step back, a huge step back, and not get involved anymore, or at least wait, is because we are not sure at that moment in time if we are offloading positions. And offloading positions is the buy position gets closed right there. So they are selling to new potential buyers above that high, people that are buying on strength, etc. And when they close that position, or they might add a new sell position even, then the low becomes the target right there, adding a lot of selling pressure to the overall market. So if we are going to continue lower, then that high, the context target, is going to be used as a liquidity to offload positions to potentially reverse the overall market. That's why it's very important when we have reached the context target, we are not inside a context area anymore. Don't look for new trades on, for example, the 15-minute time frame. That is extremely important to understand. Otherwise, you're going to be taking trades on the lower time frame everywhere. So there's an order to this, and that order is something we'll go over in a little bit as well. Now, this daily offloading of those positions, what does that look like on the 50-minute time frame right there, those offloading of positions? Well, that looks something like this. Same fair value gap, the same swing high right there. And then instead of following through, we get a sweep of that high right there to then create somewhat of a sharp turn, to then eventually create bearish order flow to continue lower, where that low is then the target overall. Now, what happens when context is taken and we do not offload positions? Then something happens like this, where we just simply continue higher. So that swing high was taken, was traded above right there, and we do not offload positions, so we do not continue lower, we do not add extra selling pressure to the market. Overall, there's still a higher term objective, for example, and we can still look to continue higher. So on the daily, there's no offload of the positions. So we simply continue higher right there. Or there's a small offload. Of course, we're not 100% certain on what happens, but at least there's not a huge offload of those positions where there's a huge selling pressure added to the market and we continue lower. That's not what happens. Okay, then what we want to do right here is we want to go down a singular time frame. So currently I'm using the daily to the 4-hour as example, but this could very well be the weekly to the daily, or the monthly to the weekly, or even the 4-hour to the 1 hour. You go down a singular time frame to find new context. So that will look something like this. So on the daily time frame, it looks something like this, where we have the fair value gap, the context area, etc. On the 4 hour, once that context high is taken, the daily context target is taken, that might be a 4 hour fair value area right there with a 4 hour fair value gap overlapping as well. This is now our new context area that we want to trade from. We can also wait for a new daily context area, but when we're waiting for a new daily context area, it won't happen that fast. It will take some time again before we actually create a new good fair value area right there. So go down a time frame to capitalize on this new expansion candle right there that we see on the daily time frame. And that will look something like this on the 4 hour time frame. Now, do we enter right here on the 4 hour time frame? No, because now the 4 hour time frame is our usual context time frame. So is our context time frame. So what happens is we remove the daily time frame right there. This slides towards the left because this right now is our context time frame, and our entry time frame would be, for example, instead of the 50-minute, something like the 5-minute right there. So from the 4 hour to the 5-minute, and on the 5-minute, it just simply repeats because now we get again a market maker model. We have the same fair value gap right there. We have the same swing high right there, and the same thing happens on the 5-minute time frame. Our market maker model to target that context target and trade within that context area overall. But it's important to understand that once context is taken on one time frame, then either we are offloading positions. When we are offloading positions, we ideally want to just take a step back, don't necessarily do anything. So that's the first thing we have to monitor. Are we offloading positions at this moment in time? If not, and there's no offload happening, we can go down a time frame to find that new context area to then trade from that again. Okay, now this all leads to then the need of the understanding of a sweep versus a run on liquidity. So either the offload of positions is a sweep of liquidity. A run on liquidity is no offload of positions, or of course a small offload, at least not a huge offload of positions. So right here, an offload is very aggressive. It's an aggressive move. Now that's something we're going to dive deeper into. That's important to understand. An offload is what we refer to as a sweep right there. So when we sweep liquidity, we are offloading positions right there. Institutions are offloading positions. That leads to an aggressive sweep. Now, no offload of positions is a run on liquidity. And when we are not offloading positions, we are comfortable above a high. So when we are comfortable above a high, we can confidently say as well, we are not offloading positions, or most likely we are not offloading positions, and we can actually continue higher in a direction. So we can find new context to continue higher. Now, right here, offloading is trapping people because they need the liquidity. So it's very important to understand when there is a sweep happening, institutions, they need to move, or they make the move very aggressive because they actually need the liquidity. So let's take a chart example to understand that a bit better. So here we are on gold, and we're on the weekly time frame at this moment in time. We have this weekly fair value gap right there, which also leads to this context target right there in the form of that high. So this creates a context area right here. This is perfect. High time frame level towards that next higher time frame level as well. Okay, then if we go into the daily, we actually see the same thing happen right here. We have this daily fair value gap right there. This leads to this context target, the first premium rate that we encounter. In this case, it's not a swing high. It's a previous candle high. Now, it's important to take into account right here that if we are going into the 15-minute time frame, for example, for the daily context right here, then we still want to look at this context area right here. So yes, we are inside bigger weekly context right here as well, but we treat them as individual context areas essentially. If we are looking at a 4-hour entry to target overall the weekly context high, you can perfectly fine look for any entry that you want right here. But when we're talking about lower time frame entries, 15-minute entries, and you're looking at this daily context area right there, then you need to take into account the daily context high target right there as well. Very important. Now, once we have reached that target, what can we do again? we can go down a time frame right there, so from the daily into the 4 hour, to see if we have new context right here. And what do we see? We have new context right there as well, where we have this 4 hour fair value gap towards this 4 hour swing high right there as well. And after, the cycle repeats. So we can go down a time frame to find new context, etc. Now the important part is how we retrace back into this fair value gap right here. Because what do we actually see at this moment in time? When we take this daily context target high right there, we see that we are not creating a fair value gap above it. Now, as a general rule of thumb, when we are running liquidity, I like to use the rule of thumb, well, if we create a fair value gap exactly overlapping with the high right there, then most likely we are running it and we can actually look to continue higher. But that's a general rule of thumb, because that's not what this is actually about. A run on liquidity is if we are comfortable above that high, or there's no need, there's no aggressive move to continue lower. That means we're actually running that liquidity. So when we take this high right there, when we trade above that high, what do we see? Well, first of all, we see on the 4 hour that this is actually a fair value gap that is created in the first place. What does that mean? Well, that means if that fair value gap was not created, then this down candle would have been a lot more aggressive right there. So the fact that we already have a fair value gap being created in the first place tells us, well, it's not an extremely aggressive down candle right there, because otherwise we wouldn't have created the fair value gap in the first place. Now, if we go down a time frame, we'll see it more clearly right here. When we take this high right here, we don't really have an urgency at this moment in time to immediately continue lower. So what we'll notice is on the 15-minute time frame right here, we have this order flow lag coming back into the previous context area after potentially sweeping this high. Now, this order flow lag, if this is truly such an aggressive move to continue lower, and we are going to be targeting the daily context low that we had, which is this low right there, then what would happen? Well, something like this. We would respect the first fair value gap that we have right there to then immediately continue lower. Minimal retracements, beautiful token rejection to immediately continue lower because it's an aggressive move continuing lower. That's important to understand. This is a huge retracement, a very deep retracement. There's no sense of urgency. Now, why is this urgency important, and why are we talking about aggressive moves and comfortable moves? What is the point of this? Well, if they are offloading positions, and let's say they are looking to sell above this high right there, the daily context high that we just took. So to add a full picture to this, what happens right here? If they are buying at this moment in time, okay, then they are offloading positions potentially above that high right there. Now, when they are offloading positions, because at this high, there are loads of new willing buyers right here because the market is strong, because we are taking out swing highs, then they also have the opportunity right here to add a potential sell position. So what do the buyers do that buy on strength at this moment in time once we take that high? They move their stop loss below recent swing lows. What is a recent swing low? The recent swing low on the daily time frame is this low, the context low right there that we just looked at as well. So when they are selling right there, the institutions, and they are tricking people into the market right there with buys, and this is perfect liquidity for them to potentially continue lower. Now, not only is this perfect liquidity for them to enter, it's also perfect liquidity for them to exit the market. What does that mean? Because this stop loss right there is a sell position. So someone needs to buy. Now, what is this take profit right there of this overall sell position? That is a buy order. So they can exchange for their take profit. They need a stop loss right there. So they can exchange those orders again, and they can get out of the market with this trapped liquidity as well. So you can imagine if this right here, if this position gets comfortable above this high at the moment where they can go break even, they might be able to mitigate their losses right there, they are not aggressively moving lower, then there is no liquidity. There is no take profit liquidity right there. So that's important to understand. that they need to trap that liquidity. They need to keep them trapped in order to use their liquidity as well. So that's an aggressive move lower versus a comfortable move. So if we take a look at this scenario right here, because when we tap into this 4-hour fair value gap right here, what actually happens on the lower time frame? On the 15-minute time frame, this also looks like a sweep of this low right here to then target these highs right there. So imagine the same thing. Right there, we have people trying to get involved. Opposite institutions are buying right there. Stop loss above the highs right there. Take profit above the highs as well. Now look at the difference in aggressiveness overall if we compare this move right here towards this move to continue higher right there. See how extremely aggressive this move is right here, where we only have one small sting into it, a fast sting to immediately continue higher again towards that high to take that liquidity right there. That is an aggressive versus a comfortable move. Very important. Then once we take this high, the cycle repeats again. So what we see right here is the same thing. We have this consolidation after taking that high. Now, once we have a consolidation after taking a high, there is, in my opinion, there's more of a chance to still continue in the direction of the overall consolidation. Meaning, we take the high, we consolidate, we are comfortable. We are not aggressive. There's no urgency to continue lower right there. The only way where we might still continue lower in this moment in time is if we now sweep the consolidation high to then run the consolidation low to then continue lower. But we see that we create this consolidation and we run the consolidation high. So we are again comfortable above the consolidation high right there. Now, start studying this on your own because this is important to understand. So simply start looking at your chart and understand, well, where did previous sweeps happen? All right, let me just study how those sweeps actually happened. Are they aggressive moves or are they very comfortable moves? And if it's a comfortable move, it's a consolidation like we just saw. Did we still get a sweep of that consolidation one last time to then create an aggressive move? And I can, well, 9 out of 10 times, we will create a very aggressive move when it is a sweep. And when we are running highs or running lows, it's comfortable. There's no urgency there. Start studying that. Very important. Okay, now, moving on, we move on to the order because there's a certain order that we need to stick to when it comes to trading from order flow. And the normal order that we have is the following. Usual context towards an order flow entry. Usual context is all the things we have gone over thus far. Order flow entries is not necessarily something we've gone over thus far. The market maker model, which we will go over in the next video as well. But this is the normal order, essentially. Now, usual context, we want to find that on the highest time frame possible. Now, we'll dive into that in a little bit. Now, this can also happen, and this is essentially also a normal order, but this is when we create that fake order flow. So not that normal order flow, we have that fake order flow lag first. So we first of all have unusual context. Inside that unusual context, we also want to find usual context to then again the normal order flow entry as well. Now, the usual context, we always want to find it on the highest time frame possible. So what does that mean? Working down timeframes. Let's understand this. Because when we want to find usual context, we simply use the timeframes that we have. So the monthly, the weekly, the daily, the 4 hour, 1 hour, 50 minutes, 5 minutes, and the 1 minute to work our way down to find on which time frame we have the usual context. So if on the monthly right here, we don't have a fair value gap just yet, we don't have any kind of usual context just yet right there, perfect. We can move on to the weekly. Now, let's say the weekly also doesn't have any usual context right here. Okay, then we move on to the daily. Now, let's say the daily right here does have usual context right there. Okay, then we don't move any lower and we take a look at that daily usual context. We wait for that to sting back into it and to play out overall right there. So here, you would not go back into the 4 hour time frame right there. Now, let's take a look at an example. We don't have to move very far because we can use the exact same example that we did on gold. So on the monthly right here, we see this monthly candle is currently forming. Now, it's most likely reaching for that previous candle high, and then afterwards we'll see what it wants to do at that moment in time. But there's no monthly context, no monthly fair value gap. Perfect. On the weekly, we have weekly context. Okay, so we use this weekly context right here. We don't go down the time frame. Now, once we start to continue higher right here of this weekly context area, the weekly fair value gap, we do the exact same thing in this area right here. Because now, if you go down the time frame, okay, we have daily context right here. So there's no need to go into the 4 hour at this moment in time to find 4 hour context. Unless we start to take out that high right there, okay, we can now go into the 4 hour. We now have 4 hour context right here to trade from right there. So when finding those usual context areas, you constantly go down one singular time frame. So it's important right here at this, the most recent price action, if we remove the rest and we take a look at the weekly, do we currently have weekly usual context to trade higher from? No. So do we have daily usual context to trade higher from? No. Do we have 4 hour? Yes, right here. So you would want to use 4 hour context right here to continue higher. Now, is it good context? In my opinion, it's not looking that great, but that is what you want to do. You don't want to go now into the 1 hour to then find fair value gaps within that 4 hour fair value gap right there, because I see that sometimes where people go into the lower time frame to now find 50 minutes and 1 hour fair value gaps inside their already established usual context area. That's not what you want to do. You just want to find the highest time frame usual context, then simply stick to that. That's all. Now there's one scenario where this is not the case. So working down time frames, and a rare scenario where you would still go down time frames is the following. So let's say the monthly, we don't have the usual context. The weekly, we also don't have it right there. The daily, we have a breakaway gap. So it's not a fair value gap that we expect a retracement back into. That's why it's a breakaway gap. So we're not expecting a retracement back into that daily fair value gap. So we can go down a time frame to find a 4 hour usual context, 4 hour fair value gap instead. So in a scenario where we create a breakaway gap on any of those time frames, you can still go down a time frame, down time frames, to find the usual context still, because we're not expecting a retracement back into that breakaway gap. So it's not usual context for us. Very important. Okay, then this is usual context essentially explained. Now, homework right there. Spot, it's a typo right here. It's supposed to be usual context. Spot usual context and start seeing those entries. Very important to study this for yourself, especially those sweep versus runs as well, because I can explain it, but unless you see it with your own eyes, you won't really understand it. Then from this, from understanding those usual context areas, we will move on to how we can enter within those usual context areas as well. All right, perfect. Thank you.